Hey everyone, and welcome to today's Explainer. I am absolutely thrilled to have you here because today we're doing a really cool deep dive into a brand new financial product. We're going to unpack a massive 76-page draft scheme information document released by Mirae Asset Mutual Fund. Our goal? We are going to completely demystify their BSE Midcap 150 Momentum 30 ETF. If you've ever stared at a super complex financial product and thought, okay, what is actually going on under the hood here? Well, you are in exactly the right place. We're going to take all that heavy regulatory text and financial jargon and translate it into a clear, easy-to-follow narrative. So let's just dive right in.
All right, here is our roadmap for today. First, we'll decode the fund name, then explain the momentum strategy. After that, we'll look inside the portfolio, check out the passive management under the hood, understand tracking error, and finally assess the risks. Starting off with Section 1, decoding the fund name, unpacking the jargon. Okay, financial product names can be a total mouthful, right? But this one actually tells a pretty fascinating story of two very distinct groups. On one side, we have the BSE Midcap 150. Think of this as a massive casting call. It's a broad parent universe representing 150 mid-sized companies trading on the Bombay Stock Exchange. But here's the catch. The fund doesn't just buy all 150. Nope. It applies a really strict filter to arrive at the Momentum 30. It narrows down that giant universe into an elite, highly curated squad of just 30 companies that are showing persistent upward performance. It's essentially the story of how a massive, broad market gets distilled into a super concentrated, high-conviction portfolio.
And of course, the whole name wraps up with ETF, which stands for Exchange Traded Fund. Now, why does that matter? Well, unlike a standard mutual fund where you're locked into buying or selling at whatever the price is at the very end of the day, an ETF is a real game changer. It's an open-ended scheme, sure, but its units are listed and traded on stock exchanges, like the NSE and BSE, exactly like regular company stocks. That means everyday investors like you and me can buy and sell units continuously all throughout the trading day at market-driven prices.
Moving right along to Section 2, the momentum strategy explained, building the index. So how does a stock actually survive the cut and make it into that top 30? The document lays out this incredibly strict, rules-based gauntlet. This isn't about some fund manager sitting in a room making subjective guesses. It's a pure mathematical history of a stock's performance. First, obviously, it has to be in that parent BSE 150 Midcap Index. But look at those bottom two criteria on your screen. This is where the magic happens. A stock must have traded on literally all working days during the reference period. And, this is huge, it has to have a turnover ratio of at least 20%. That guarantees they are only looking at highly liquid stocks. Basically, the math finds the 30 companies showing the most persistent momentum. And if a stock starts losing steam, boom, it gets systematically booted out and replaced by a new rising star during their periodic rebalancing. No emotions, just data.
Which brings us to Section 3, inside the portfolio, where the money goes.
So what do these strict rules actually produce in the real world? Based on the document's initial snapshot, here are some of the heavy hitters that survive the gauntlet. We're talking about tangible companies you might recognize, like GE Vernova, Multi-Commodity Exchange, and Cummins India. But hey, take a really close look at that weightage column. Notice how all the numbers are hovering right around that 5% mark? That is totally intentional. The index uses a strict capping algorithm. It explicitly caps the weight of any single stock at 5%, and if a stock grows past that, it redistributes the excess to the others. It's a brilliant, built-in risk management tool to make sure the whole portfolio doesn't get dangerously top-heavy relying on just one runaway stock.
Okay, Section 4, Passive Management Under the Hood, the Asset Allocation.
You know, the true beauty of passive management is just how straightforward the asset allocation is. A massive chunk, a minimum of 95%, and up to 100% of the fund's capital is invested straight into the actual securities that make up the index in the exact same proportions. The manager is literally not trying to beat the market at all. Their only job is to flawlessly mirror it. Now, what about that tiny sliver left over? That up to 5% is kept strictly in debt and money market instruments, like treasury bills, and it's only sitting there for totally practical reasons, managing daily liquidity, handling redemptions, or just acting as a tiny short-term defensive buffer.
All right, Section 5, understanding tracking error, mind the gap. Now, I want to pause for a second and pose a question. If an index is basically a flawless mathematical concept sitting on a piece of paper, can a real-world fund dealing with actual cash, trading fees, and human execution flawlessly copy that index every single second of the day? The answer, of course, is absolutely no way. And that inevitable gap between perfect math and messy reality, that's what the finance world calls tracking error. The document defines it pretty technically as the annualized difference of daily returns between the fund and its benchmark. But really, just think of it as the friction of reality. Stuff happens, right? Companies pay dividends. There are corporate actions. There's a tiny bit of cash drag from that 5% money market allocation we just talked about. And markets bounce around while the fund is trying to rebalance. All of those little things cause the real-world fund to slightly drift from the pure index.
But don't worry, it's not a free-for-all. To put that into perspective, the document gives us a really concrete boundary. Under normal market circumstances, the asset managers expect this tracking error will not exceed 2% per year. So it's essentially a promise from the fund managers saying, hey, we're going to keep this portfolio as tightly chained to the benchmark as physically possible to keep that friction to a minimum.
And finally, Section 6, assessing the risks. Radical transparency.
Now, we absolutely have to look at the realities here. This is the official scheme riskometer, pulled straight from the regulatory document. As you can clearly see, that dial is cranked all the way to the right into the red, very high risk zone. And we're just reporting the facts neutrally here. An ETF tracking 30 momentum-driven mid-cap stocks is inherently volatile, period. Mid-cap companies are smaller, so they tend to experience way sharper price swings than massive blue-chip stocks. And honestly, a momentum strategy literally involves buying stocks that have already gone up a lot, which means if the market turns, they can reverse course incredibly fast.